In the interest of unlocking the somewhat opaque doors of venture capital, behind which are the inner workings, incentives, and decision-making processes of VCs, let me start by more properly introducing myself. The first thing to know about me is that if I weren't a venture capitalist, I would sing country music in Nashville. But lucky for everyone who is a real country music fan, and for my ability to support my family financially, I somehow found my way into the VC business. I live in Silicon Valley, not Tennessee, so the best I can do is wear cowboy boots to work and play the guitar in my spare time, both of which I do as often as possible. Let me give you a little bit of context about what the tech and investment world was like when I was getting started in the 1990s. Some of the big tech names back then were ePiphany, NetIQ, VA Linux, Commerce One, Razorfish, and Ask.com. It's possible you haven't heard of any of these companies, but they, like me, were products of the 1999 to 2000 tech bubble that produced roughly 900 initial public offerings of venture-backed tech companies. It was a great time to be starting out in the tech industry, as there seemed to be no end to the promise of technology and to the amount of wealth creation that was available to everyone involved. Netscape had gone public in 1995, a mere 18 months after its founding, receiving a huge amount of media attention and heralding the beginning of the dot-com boom. Google wouldn't be founded until 1998, but Silicon Valley was already fired up with dot-com fever. New internet startups were appearing daily. The tech world was abuzz. Venture capitalists, VCs, were investing in new companies at an unprecedented pace relative to historical norms. About $36 billion went into new startups in 1999, which was approximately double what had been invested the prior year, although that's now less than half of what was invested in 2017. Additionally, limited partners committed more than $100 billion of new capital to the venture capital industry in 2000, a record that hasn't come close to being broken since. By comparison, limited partners committed about $33 billion in funding in 2017. Startups were also getting to an IPO faster than ever during the dot-com bubble. On average, it was taking companies about 4 years from funding to go public, which was a huge acceleration of the historical trend of taking 6.5 to 7 years to IPO. Today, that time period often exceeds 10 years, for reasons we'll get into later in this book. In addition to a record number of IPOs, the public markets were also exuberant. On March 10, 2000, the NASDAQ index, the barometer for technology stocks, peaked just above 5,000. More interesting, the price-to-earnings ratio, P/E ratio, of the companies listed in the NASDAQ index stood at 175. This means that stock market investors were valuing $1 worth of a company's earnings at $175. While it's generally the case that investors value $1 of earnings today at some multiple greater than 1 because a company's stock price is intended to reflect the present value of the cumulative cash flows of a business into the future, a 175 multiple is a historical anomaly. For comparison, the NASDAQ P/E ratio today is under 20, which is generally in line with the long-term historical trends for the index. At the time, Cisco was anticipated by many to become the first $1 trillion market capitalization company. Alas, Cisco's market cap peaked at about $555 billion in March 2000. Today it stands around $200 billion. Early in 2018, Amazon became the first $1 trillion market cap company, albeit for a brief time, and as of this writing sits at around $800 billion. Fun fact, in March 2000, Amazon's market cap was a mere $30 billion. What could possibly go wrong? So back in 2000, everyone was on a collective sugar high to end all sugar highs. What could possibly go wrong? As it turns out, a lot. The NASDAQ index began a precipitous decline from its March 2000 peak, falling all the way to its nadir of just above 1,300 in August 2002. While there is much Monday morning quarterbacking about the impetus for the decline, many market analysts point to the Federal Reserve's aggressive interest rate tightening in early 2000, which created a big debate as to the sustainability of heavy borrowing that many technology infrastructure companies had undertaken.